The Reserve Bank of India, or the RBI as we commonly call it, is our country's central bank. Think of it as the main bank for all other banks in India. Its job is very important. It manages the country's money, makes sure our banking system is safe, and tries to keep prices stable. A key part of this is deciding interest rates. This big responsibility is handled by a special group within the RBI. This group is known as the Monetary Policy Committee, or MPC. The MPC meets regularly to look at how the economy is doing. They then decide what actions are needed to keep things on track, especially regarding inflation and growth. Their decisions affect everyone, from big businesses to you and me. The MPC is made up of experts. Some are from the RBI itself, including the governor, and others are appointed by the government. Together, they analyze a lot of data. This includes information on prices, how much factories are producing, how much people are spending, and what is happening in the global economy. After careful consideration, they vote on what to do with key interest rates. The main tool they use is the repo rate. This is the interest rate at which the RBI lends money to commercial banks. Changes in the repo rate have a ripple effect across the entire financial system, influencing the interest rates that banks charge us for loans. Just today, on June 7, 2025, the Monetary Policy Committee made a significant announcement. They decided to cut the repo rate. The cut is by 50 basis points, which means 0.5%. So the new repo rate is now 5.5%. This is quite a big step. It shows that the RBI wants to make borrowing cheaper. This isn't the first cut this year either. The RBI had already reduced the repo rate twice before, by 25 basis points each time, once in February and again in April 2025. So, in total, we have seen a good reduction in the repo rate recently, signaling a clear direction from the central bank. But that's not all the MPC decided. They also announced a cut in something called the cash reserve ratio, or CRR. The CRR is the percentage of a bank's total deposits that it must keep with the RBI as cash. The MPC has slashed the CRR by 100 basis points, which is a full 1%. This means banks will now have to park less money with the RBI. This leaves more money in the hands of the banks themselves. This twin decision, cutting both the repo rate and the CRR, is a powerful signal. It clearly indicates that the RBI is taking strong measures to boost the economy. So, what do these technical terms, repo rate cut and CRR cut, actually mean for the country and its people? Let's break it down simply. When the RBI cuts the repo rate, it makes it cheaper for commercial banks like State Bank of India or HDFC Bank to borrow money from the central bank. If banks can get money at a lower cost, they are more likely to pass on this benefit to their customers. This means the interest rates on loans that you and I take, such as home loans, car loans, or personal loans, could come down. Businesses also benefit as their borrowing costs for expansion or operations can reduce. The cut in the cash reserve ratio, or CRR, works in a slightly different way, but with a similar goal. As we discussed, CRR is the portion of money banks must keep with the RBI. By cutting the CRR by 1%, the RBI is essentially allowing banks to hold on to more of their deposits. This directly increases the amount of money available with the banks. With more funds at their disposal, banks have a greater capacity to lend to individuals and businesses. This increased liquidity in the banking system is aimed at encouraging more lending activity, which in turn can fuel economic activity and demand across various sectors. When borrowing becomes cheaper and more money is available, it generally encourages people and businesses to spend and invest more. For individuals, a lower interest rate on a home loan might make buying a house more affordable. Someone wanting to buy a new car might find the equated monthly installments, or EMIs, more manageable. For businesses, lower borrowing costs can make new projects or expansions more viable. They might be more willing to invest in new machinery, hire more people, or increase production. This chain reaction of increased spending and investment is what helps the economy to grow faster. Therefore, these recent decisions by the RBI are designed to give a push to economic activity. By making it easier and cheaper to access money, the central bank hopes to stimulate demand. When people buy more goods and services and businesses invest in growth, it creates jobs and increases incomes. This positive cycle is what policymakers aim for, especially when economic growth needs a bit of a nudge. The RBI is essentially trying to make money work harder for the economy, ensuring that funds flow smoothly to productive areas and support overall national development effectively. For a long time, a major worry for the RBI has been inflation, that is, the rate at which prices of goods and services rise. Keeping inflation under control is one of the RBI's primary mandates. However, the situation seems to have changed recently. The latest data on retail inflation, which measures the price changes for things we commonly buy, showed that it has fallen to a 69-month low. This is nearly 6 years. When inflation is low and stable, it gives the RBI more room to focus on other important economic goals, such as boosting growth, which is precisely what it seems to be doing now. With inflation appearing to be less of an immediate threat, the RBI has shifted its priority. The central bank has indicated that price stability, while still important, is currently a secondary concern compared to reviving economic growth. This is a significant policy pivot. The RBI has also changed its monetary policy stance from accommodative, which it adopted in April 2025, back to neutral. An accommodative stance usually means the RBI is open to more rate cuts. A neutral stance, on the other hand, suggests that while further rate cuts in the near future are not ruled out if growth disappoints significantly, the RBI is also ready to raise rates if there's an unexpected and sustained surge in prices. The RBI is also reasonably optimistic about the country's growth prospects. It projects that the Indian economy will grow at a rate of 6.5% for the financial year 2025 to 2026. This projection is quite similar to the government's own provisional estimate for the previous financial year. Achieving this level of growth, or even surpassing it, requires supportive policies, and the recent rate cuts are a step in that direction. The timing of these decisions is also considered quite sound by many experts. With inflation low and not expected to spike suddenly, and no major elections on the immediate horizon that might necessitate a tight grip on prices, the environment is conducive for growth-oriented measures. This focus on growth is crucial for India. Higher economic growth means more jobs, better incomes, and improved living standards for millions of people. It allows the government to collect more taxes, which can then be spent on essential public services like healthcare, education, and infrastructure. When the economy is expanding robustly, businesses thrive, innovation flourishes, and the country becomes more competitive on the global stage. By taking steps to lower interest rates and increase liquidity, the RBI is playing its part in creating an environment where such growth can take root and flourish, benefiting everyone in the long run. It's not just the RBI that is focused on boosting economic growth. The Indian government is also on the same page. This alignment between the country's central bank and its fiscal authority, the government, is very important for achieving national economic goals. When both institutions pull in the same direction, the impact of their policies is much stronger and more effective. The government, through its budget and spending decisions, also plays a critical role in shaping the economic landscape. The recent monetary policy actions by the RBI are expected to complement the government's own efforts to stimulate the economy and ensure sustained development. The government has its own set of financial commitments and priorities. For instance, Finance Minister Nirmala Sitharaman and other Finance Ministry officials have indicated that while government capital expenditure has seen significant increases over the past decade, it is now expected to be maintained at its current level, rather than growing substantially further. This means the government is looking to sustain its investment in infrastructure and other productive assets. At the same time, the government has additional spending needs to consider. These include crucial areas like national defense, which always requires substantial resources, alongside ongoing developmental projects and social welfare programs that aim to uplift various sections of society. With these varied spending requirements, a supportive monetary policy becomes even more crucial. If borrowing costs are lower for the government as well, It can manage its finances more effectively. More importantly, by making credit cheaper and more accessible for the private sector, the RBI's actions can encourage businesses and individuals to take the lead in driving investment and consumption. This helps to reduce the burden on direct government spending to solely power economic growth. Monetary policy, therefore, is expected to play a very significant role in helping India achieve its growth aspirations in the current fiscal environment, working hand in hand with fiscal measures. Ultimately, the fact that the RBI and the government are in agreement on the need to prioritize and boost growth is excellent news for the Indian economy. This synergy ensures that policy actions are coordinated and do not work at cross purposes. When the monetary and fiscal authorities share a common vision, it creates a stable and predictable policy environment, which is highly valued by investors, businesses, and the general public. This coordinated approach, focusing on making India a more prosperous nation, is vital for our long-term economic health and for ensuring that the benefits of growth reach every citizen across the country.